After the spate of bad news that we have been witnessing in recent months, here is some good news. About 75 to 80% of the negative news is already factored into stock market prices. The stock markets may at best have another 2 to 3 months of correction to see. These views were expressed to us by Trideep Bhattacharya, CIO Equities, Edelweiss Mutual Fund. He spoke to us on the occasion of the launch of the fund house's Focused Fund. Explaining the rationale behind launching such a fund, he said that a minority of stocks have always accounted for the bulk of returns in the stock markets. Do watch this interview for more details. Good evening, Mr. Bhattacharya. Thank you for taking time out to speak to us. My first question is the worst of the market correction behind us, or do you see the market correcting further? Rather, what are some of the key factors that will determine the course of the markets hereafter?
Thank you very much for having me on the show, Sanjay. And a great question to start the conversation with. And I would say that, we've been kind of having this view that the period starting Jan 22 to March 23, broadly where we are in, should be seen as a tale of two halves, where we always expected the first 6 to 9 months of this year to be volatile, not outright bearish, but volatile, where money making would be difficult and should be seen as an investment time really. And this was meant to be driven by three factors. First, the fact that we are seeing an interest rate regime change from falling interest rate to rising interest rates. Secondly, transient it may be, but inflation is still an issue to contend with. And third, the geopolitics of it. So we always thought that the first 6 to 9 months would be tough for the markets. And here we are. It has been quite a volatile time frame so far. But the good news is that we are in the final 1 or 2 months of this 6 to 9 month time frame, where overall we feel that 75 to 80% of the bad news is there or thereabouts in the price. And hence we feel that while since the beginning of this year, we have been kind of advising particularly caution in terms of investments. And we have been suggesting that in case you want to invest in tranches, invest in SIPs. Now we are saying that one can look at the market even from a lump sum standpoint, incrementally speaking. Well, so to answer your question, we do expect volatility to last for the next couple of months, but we think that we are in and around somewhere in and around the peak of negative news flow, while 75 to 80% of the bad news is there or thereabouts in the price. The last 10-15% is always difficult to time. And hence we recommend incrementally that people should look at equity markets from an investment standpoint than staying away from.
That is quite a relief to know. So we read about all the bad news in the newspapers. What, in your view, are the positives for this market?
So I think, as I was saying, that we're in the final 2 or 3 months of this tough phase of market. I mean, if you look at the biggest issue that the market has been contending with has been inflation. That is by and large driving the interest rate outlook in the United States as well as in India. In this context, what is interesting to know that in the last 1 month or so, we've seen good bit of correction in industrial commodities like steel, copper, of late oil as well, and some farm-based commodities as well, which makes me feel that some of the lead indicators to the commodity-driven inflation are gradually cooling off, at least from the high levels that we have seen before. Second, some of the supply chain challenges that the various sectors of the economy have seen, like chip shortages and whatnot, are also in the process of getting resolved. So overall, there's a good chance that the inflation might ebb in the next couple of months overall, and that would ultimately bring cheer to equity markets and investors in general. If you look at further out from a 2 to 3 year perspective, I would say that India is in a decent shape from fundamentally speaking. And this constructive view on Indian equities from a 2 to 3 year perspective is really driven by 3 key reasons. First, we think there is a good chance of a private sector driven capex cycle to come through over the next 2 to 3 years. Second, we think that the real estate cycle which has been in doldrums for the last decade, is finally coming around with inventories across India in the process of bottoming out. And third, for the first time, we saw last year double-digit salary hike coming through. And we feel that while near-term consumers are saddled with high inflation, in a year's time, we could see them come back from a consumption spending standpoint as well. So three important parts of the economy over the next 2 to 3 years will likely kick in the gear. One is the industrials, capital goods segment. Second, real estate. And third, maybe in some form, consumption spend. If I add on top of that the fact that there's national elections in 2024, and government probably will be in pro-growth mode from here till then, overall the major sections of the Indian economy looks fundamentally robust from a bottom-up standpoint, and hence something to look forward to, something to cheer about from economic as well as market standpoint over the medium term.
You have chosen to launch a focused fund right now. What are some of the positives of a focused fund? Why should investors go for them?
So, as I said, that 75 to 80% of the bad news is there or thereabouts in the price. Hence, we thought that even though we've had this approval for a while, that this might not be a bad time to launch from an investor standpoint, given the negative news flow that are there or thereabouts. From a 3-year perspective, the valuations are reasonable. The reason why we went ahead with a focus fund is because there was a study done in the United States which showed that 4% of the stocks in the United States explain 100% of S&P 500's returns over a period of 100 years. The same kind of study rhymes well for Indian markets as well. So basically, in a nutshell, a few stocks explain majority of the returns of the stock market. In economic parlance, there's a huge positive skewness with regards to stocks when it comes to equity market. Hence, in a nutshell, in our opinion, focused investing works. And that's why we went for focused fund as a category rather than many others that were available.
What will your investment approach in this fund be?
So one of the ways we want to differentiate in this fund is that we want to focus on themes or investment opportunities which are very relevant to India in the stage of evolution that it is in the global landscape. And in that context, we see 3 themes particularly relevant to India at the current moment and the strongest ones. Number one, brands. Number 2, market share gainers. And number 3, innovation. In the form of brands, we think that India's time for brands has come, particularly as we migrate from per capita GDP of $2,000 to $4,000. We think that over the next 10 years, the brand adoption in the economy will grow, and we want to participate in the same. In the name of market share gainers, we want to participate in the companies that have gained, particularly in the organized sector, at the expense of the unorganized sector, driven by the reforms that we have seen in the Indian economy. And finally, in the theme of innovation, we want to play the adapters and the enablers, which in my opinion are the sweet spots to play the innovation, not just in happening in India, but also globally. So in the form of these 3 themes, we look to differentiate what we own versus what we have in the competition.
Do you think that a focused fund is more suited for a particular kind of investor, given that it has more volatility? Do you have a profile in mind?
We think that at the end of the day, we are owning a 25 to 30 stock portfolio, and hence a concentrated portfolio, and that comes with volatility. And hence we are looking to target investors who have 5 years or more investment horizon from an investment standpoint. However, we want to give the comfort for those investors, particularly in the times of high volatility, that the themes that we are focused on are the long-term themes which are very relevant to India, and in our opinion, the strongest wealth creation themes that the Indian investor can actually participate in. And that should assuage the fear of volatility that we might see on the way. But we remain convinced that the stocks that we put together in this particular portfolio, if an investor has a 5 years plus kind of a horizon, is a decent place to be.
Thank you, Mr. Bhattacharya. It was a pleasure speaking to you.
Thank you very much for your time. Thanks for your question. Happy investing.